Good morning, good afternoon, and good evening, depending on where you're joining us from, to everyone. I'm Smita Mishra, founder and CEO of Fandoro Technologies, and I'm going to be your host and moderator for today. And I'll also have to keep admitting people, so kindly excuse me for the interruptions. At Fandoro, we are on a mission to make sustainability simple, practical, and impactful for businesses and investors. Through our blend of digital tools and expert advisory, we help organizations to go beyond compliance to build purpose-driven, resilient, and future-ready enterprises. I'm delighted to welcome you to the Responsible Edge, Conversations for a Sustainable Business Future, which is a platform we are curating to spark real dialogue and showcase leadership in sustainability. Our goal is bold, ensuring that admitting people. Yeah, our goal is bold. We want to ensure that only planet positive businesses thrive. We have been fortunate to work closely with venture capital teams and startups across the country, helping them weave ESG and SDG practices into the very fabric of their operations. This series is about catalyzing the shift we all want to see, where sustainability becomes the default way for doing business. Today, in episode 4, titled SDGs and ESG in Action, Scaling Purpose-Led Innovation, we will explore how investors are aligning business goals to SDG priorities and ESG risks, the frameworks, tools, and the case studies around this theme. You can use the scan code. So let me just show you where we are. You can see the scan code here, and you can use it for registering with any future webinars which we are going to do. Here is the list of the upcoming webinars, and you shall see the same when you go to the link on the scan code. I'm going to stop sharing now, so we can all have everybody here. Yes. So today I'm honored to be joined by two incredible leaders in this space, Sowmya Suryanarayanan and Swarup Mishra. Thank you both for being here to share your insights, which I know will bring immense value to our community of founders, investors, and change makers. Let me start with the introduction of our esteemed speakers. Sowmya is the Managing Director for Impact and ESG at Aavishkaar Capital with over 19 years of experience in social development and sustainability. She has driven inclusive business models across clean energy, financial inclusion, education, and agriculture in India. Do I need to mute somebody? Okay. So she's driven inclusive business models across. I'm so sorry about all the disturbances. We're going to let the background happen. Yeah.
Please.
She has driven inclusive business models across clean energy, financial inclusion, education, and agriculture in India, and has held leadership roles with IFCCI, IBCA, and Grow Steering Committee. An alumna of the University of Oxford, the Indian School of Business, Stella Maris College, and St. Joseph's College, Bangalore. She has been honored with the 2023 Sustainability Impact Leader Award and also named among Forbes India W Power Self-Made Women in 2024. Welcome again, Sowmya. I think you are probably one of the finest one in the industry with a tremendous pedigree of work. We are very thrilled to have you on webinar.
Thank you so much, Smita. It's a pleasure and honor to be part of this.
Thank you, Sowmya. And our next speaker is Swarup Mishra. Swarup is the ESG Officer at Ep.4, the Dutch Entrepreneurial Development Bank, based in the Netherlands. He provides strategic, independent ESG advisory to Ep.4's investment committee and board by further evaluating ESG risks and opportunities across all global investments, both proposed and in portfolio. His oversight spans across 80 plus countries for a range of financial products, including sustainable and blended finance, deployed through Ep.4's own balance sheet as well as Dutch government funds, ensuring alignment with Ep.4's risk appetite, impact mandate, and sustainability goals. Previously, Swarup held key positions in sustainable finance and ESG at TVS Motors, NIIF, Environmental Resource Management, ERM, and AECOM. He holds an executive MBA from SDA Bocconi, an MSc from Delhi University, and certificates in sustainable finance and nature finance from the Smith School, University of Oxford. Welcome, Swarup. Our past interactions have been very, very insightful for me at my work, and I'm excited to hear your thoughts on the theme today.
Thank you, Smita, for inviting me to speak on it.
So thank you again, both of you, for joining us today. And let's get started with our conversation now. But before I get on with my questions, Sowmya and Swarup, if you would like to take maybe 2 minutes each and share with us your work journey so far, maybe primarily focusing on the nature of work you're currently engaged with in your respective organizations. And dear audience, as we progress through our webinar, feel free to share your questions in the chat and we shall try and come to them at the end. Sowmya, you want to go first with the ladies first thing?
Sure, happy to. Again, once again, I'm extremely honored and it's a pleasure to be here and talk about a topic that's very close to my heart and also been very core to my professional career as well. I head Impact and ESG at Aavishkaar Capital. We are part of the Aavishkaar Group. We are a 2-decade-old pioneer global impact fund focused on investing on that are solving complex social problems. We are about $500 million in AUM. We've raised about 8 funds. We've made about 80 plus investments. And through these investments, we've impacted about 100 million people, half of them who are women. My role essentially is to ensure that both impact and ESG is embedded within the investment process, and to ensure that we are measuring and reporting on impact. It includes multiple other things as well, but I will just stop here briefly so we can continue with the discussion.
Thanks, Sowmya. So if you want to talk some bit about it.
Yeah, as you have said in your introduction, so currently I work with FMO, which is the Dutch DFI. So in the DFI space, after the multilateral development banks, I think if one organization stands out in terms of really taking ESG, from a stewardship point of view and integrating it with all kind of financial products, creating its own tool for and making them public time and again. I think even when I was a consultant, I was pretty much admiring this factor of that FMO does. So today, I think FMO has a AUM of about 16 billion across its balance sheets. And I mean, this is not taking care of the Dutch government money and other money that FMO manages, right? And mostly FMO's investment criteria has been changed in last couple of years. Now, SDGs are kind of the core of its investment thesis, and with the focus being climate action 13 and reducing inequalities SDG 10. So anything that we do should be falling into these 2 buckets, or either entirely or partly, and that's the goal is to achieve at least $30 billion by 2030 and scale each of these labeled financial products to at least 10 billion each. So, and FMO is having one of the largest teams in impact and ESG. On the impact side, I would say we have about 20 odd colleagues tracking impact, disclosing it. ESG side, about 50. And I work with the risk team on the CRO side, overlooking the inputs coming in from these colleagues and then, advising the committees, etc., board, etc., on how to do things better or what we can do to improve. That's my overall role today.
Thanks, Swarup. So I think here
and I guess we should connect the dot that Aavishkaar is also part of FMO's portfolio, and FMO has been supporting Aavishkaar's successive funds and it's one of the good clients in India in the VC sector.
Thank you so much, Swarup, for your kind words. Of course, FMO and Avishkar, we go way long back, right? So it's always a pleasure.
Thank you.
No, it's a godsend thing because we were looking at Swarup for joining us on this panel for a previous session, and it just so happened that for some reasons he couldn't, and we had to put him here. And I was just reading his email also on this subject, and he was like, "Yeah, in any case, Avishkar, we know the team." And I'm like, "Okay." At that moment, we were not considering Avishkar for that panel because Sowmya, you didn't have those dates. But it's funny that it finally comes to it that you have both FMO and Avishkar are on this panel.
Yeah, my point of view is that you should have the LP and one of its GPs together
Oh,
to
wow.
give you both side of the views. And previously, I guess you were trying to fix up with Omnivore or Aavishkaar.
Yeah,
So
we
these are
did.
some of the
Yeah,
leading VC funds
yeah,
where FMO has been a long-standing sponsor. So it's always good to have both side views than
sure.
a view from a European capital only.
Absolutely, absolutely. So, I mean, hearing your backgrounds, while Sowmya, we are looking to have a conversation with you more on aligning business models with SDGs, showcasing how purpose-driven innovation has enabled impact across sectors like clean energy, financial inclusion, agriculture, and education. We do want to take away from this conversation as to how investors and enterprises can frame their strategies around specific SDGs and SDG targets, measure progress, and unlock opportunities for scalable, inclusive growth. Uh, with you, Swarup, I was hearing your background and I anyways know what work you've done. We are more inclined to explore how global financial institutions and investors manage ESG risks while enabling sustainable development. And drawing on your experience with FMO's global portfolio across 80 plus countries, we do want to take away from this conversation as to the frameworks, the due diligence practices, advisory strategies needed to balance impact mandates with risk appetite, and how ESG risks are being factored into your investment decisions. So, with this context setting, my first question is here. So, both of you, kind of work at the intersection of finance, sustainability, and impact. So, to start us off, how do you each define the role of ESG and SDGs in driving purpose-led businesses or business innovation today? And maybe sort of you could go first this time.
Sure. So, I mean, I just hope that everyone on the call is some sort of having a linkage to this space. Otherwise, when we speak with laymen or somebody who do not have exposure to the sector, for them, everything means sustainability, right? SDG is Sustainable Development Goal. ESG is, again, sustainability. And there are sustainability disclosure. There are just so many things to tag on and learn from. So, but in a nutshell, I would say ESG has both a risk side and an opportunity side. When it comes to financial institutions, they try to bucket issues on opportunities and risk. So typically, the opportunity side is what gets tagged along as SDGs because that's where the opportunities lie. United Nations have said these are the areas or gap across the globe where we need to focus our time, effort, and financing to bridge the gaps. So SDGs are that's why important from creating financial products to cater to those opportunities. While ESG remains more as a downside protection tool, as you chase impacts, and most of the time when the financial products are new in the market or the market doesn't exist, and you are trying to create some sort of a market for a certain SDG, there can be many unknowns, and so to prevent the reputational risk, to prevent the capital erosion, the tools that you deploy in terms of non-financial risk management, that becomes ESG in a way for financial institution size. While to the outside world, they may seem like they are synonyms in certain angles. Yeah. So that's my differentiation that I would like to put forward.
Sure. Thanks. Sowmya, you can add to
Yeah,
it.
so as you know, I'm leading both impact and ESG, and this is a question we're often asked: how do you distinguish between impact ESG or even SDG ESG, right? So both have very distinct and yet interconnected roles, according to me. So if you look at SDGs, they're often associated with impact outcomes, right? While ESG is more like a practical framework that sort of helps companies how to assess and manage their risks, maybe governance practices and social responsibilities as well. So if you look at in a very simple term, SDGs sort of tell you where to have an impact, whereas ESG shows you how to operate responsibility to get there. So that would be my distinction, and together they sort of guide innovation by ensuring businesses not only sort of aim for meaningful social and environmental outcomes, but do so in a more robust, ethical, and risk aware manner. So that would be my definition or distinction between SDG and ESG.
Beautiful. I think both of you are more or less roughly on the same lines, but yes, I can see the distinction. But I'm hoping we'll be able to come to a conclusion on how both of them could work together. Now, Sowmya, I mean, particularly because we've been talking about in this particular theme as SDGs as strategic priorities. Could you share how Aavishkaar Capital, aligns its investments with SDGs priorities, and where do you see the biggest opportunities for purpose-led growth?
Sure. So I'll just start with a little bit of a background, right? So we started this journey about 2 decades ago, and we were driven by the belief that entrepreneurs are agents of change, especially across global south. Our mission was and still is to bridge the opportunity gap of the emerging 3 billion, focusing on how jobs are being created, sustainable livelihoods, and are there like tangible pathways out of poverty, right? Using entrepreneur as a tool. So essentially, the group was built on 4 distinct principles. First, like I said, we see entrepreneurs as problem solvers. Capital needs to be used as leverage. Impact is the outcome. And for all of this to work, you need to take an ecosystem based approach. What worked very well for us is that we rooted our impact thesis in context, right? In context of where the impact is being created and understanding how it aligns with the business model. Like we as investors could be investing, in a low income state like Bihar. That is usually not drawing any sort of investments, or in Chhattisgarh, or even in an Odisha, or investing in Mumbai. So if you see in both places, you are investing in entrepreneurs that are creating jobs and livelihoods. But in a place like a Bihar or a Odisha, where the ecosystem is not even there, the quality of impact becomes very, very, deep, right? As compared to when you're investing in a Mumbai, where, there are alternatives of jobs available, livelihoods available, but not in the case of a low income state. So therefore, context becomes very, very important for us. So we look at who benefits, the livelihoods, how livelihoods are being improved, what are some of the positive changes that are happening in the community. So our impact measurement management framework has also evolved in the last 2 decades. So initially we were looking at direct impact, but now we look at indirect impact, be it how many jobs created, emissions reduced, or how are people getting access to essential services and products. Over time, we realized also the best businesses do not just help individuals, right? But they disrupt sort of old models and bring lasting changes to the sector. Our investment in Kotaram Soulful is a classic example of how, we went ahead and invested in, a millet-based company. And at that point, nobody was even looking at the space. And today, everybody is talking about millet. So those are the kind of innovations or investments we make, and that are linked to SDGs. Right. So primarily, we also benchmark our KPIs and forecast the outcomes transparently, and we map them to UN SDGs in some sense. And the I would say the alignment is with, say, decent work and growth, innovation and infrastructure, reduced inequalities. These are the primary things that we look at. But depending upon the businesses that we invest in today, Avishkar aligns with 13 out of the 17 SDGs in some form or the other. So that's how we look at impact and how it aligns with the businesses we invest in.
Wow, I'm so tempted to get deeper into this question itself, but I'm going to hold myself right now and keep it for later. And come to you, Swarup, that when businesses or investors pursue these SDG opportunities, like we just heard, what ESG risks do you typically see emerge in those cases?
Yeah, so I'll give you, for each of your questions, kind of a generic answer, and then maybe we can always talk about what FMO does, right? So, generic answer is when you chase SDG impacts as your core thesis or core theory of change of where your finance is being directed, we have certain things which we would like to call, let's say, investors call it DNSH, do no significant harm. So while you are trying to create a job, don't really harm the environment in that area. So don't target one SDG and put all the focus there while 5 other SDGs are being damaged. So that's where SDG and ESG play together to ensure that, while we are creating impact in a certain sphere, we are not putting negative impacts which are, way above the tolerance limit of the local ecosystem into the other sphere. And so how does FMO do it? So FMO basically these days we focus on basically 2 SDGs, which is one is climate action, 13, and reducing inequality. While core of the investment thesis is towards these two, job creation, SDG 10, 8 is always what you call a key KPI in measuring the additionality context, right? So like Sowmya is saying on the context is really important when putting impact finance to a certain geography. That's where you want to know what is the differential impact that you are making. And here we call it additionality. So each of the proposed investment to us, we try to see whether we are being financially additional or we are being ESG additional. So financially additional could be something like, you have the commercial banks, you have the private equity funds who are putting money into the same subject, but let's say for 10 years at a 14% interest. Whereas FMO can put that same financing in, let's say, 3.5 or 4% interest for 25 years. So there you become financially additional because that sticky capital for a long tenure with such low interest rate is not available for the local entrepreneur to scale his business. And he doesn't want to take the additional burden of, let's say, interest and profitability at a certain stage of business when he is trying to scale it up and changing a certain impact or a certain geography before it becomes profitable. So that's I think where FMO's unique proposition come into play in terms of our blended financing structures, our long tenure, our low interest rate loans, local currency loans. So that's where we're able to support the innovation through first loss capital or through sticky long-term capital. And we do it in 4 specific spheres. One is agriculture. Agriculture basically covers food systems, water, forestry, all of that. And the other bucket is energy. Energy covers energy generation, energy in terms of hydrogen, ammonia, energy efficiency into industries where you can increase efficiency significantly and reduce the carbon emissions. So energy, agri, and the other 2 buckets are basically intermediation. towards the same set of kind of goals through either financial intermediaries like banks and NBFCs, or through private equity and VC funds. Again, targeting these two buckets itself, that either we should be reducing inequality or we should be targeting climate action, and at the same time create benefits for the society, have enough benefit sharing mechanisms. If a certain impact is not the core impact that we are changing, but still we should be able to share certain benefit of the project with the local community, whether it is in terms of skill development trainings to make them more employable in future for somebody else to come and provide them a job, which you may not account on your impact sheet as job created, but at least those are the kind of intervention that we try to see from the ESG team side on how to kind of broaden the indirect impact of a certain investments.
I'm totally enjoying the passionate conversation that's going on here. It's really good to hear the thoughts that you brought to the table here, particularly with SDGs and giving importance to specific SDGs and working on ESG. But in my experience, we struggle a lot to bring companies or sometimes even investors to the table to have this discussion that ESG is important, or you should probably focus on SDG impact also. And we want to balance both the risk and impact, but we often hear that ESG risks can slow down or complicate investment decisions. So how do you see ESG risk management working hand in hand with SDG impact goals, rather than being at odds with them? Particularly with, and let me give you a quick context. Also, that the SDG impact, a lot of people do it as a backward plotting. Whatever happens through the year, they'll say, yeah, this is the impact we've created. While it's like business as usual, like really would this not have happened if you did not do it? However, when you see ESG risks, you cannot like go through the year and then say, yeah, through the year we were carrying these risks. You try and proactively work on it. So just trying to understand, how do people really how do you see the ESG risk management working with SDG impact?
Maybe Swarup, do you want to take it? And then I'll answer.
Sure. So, Smita, what you said is correct. So, in my experience, I have seen that commercial investors typically like to invest with a sound investment thesis. For private equity fund and VC funds, they have a certain hurdle rate to cross to return the capital to their LPs. So while they change certain opportunistic investments in certain areas or sectors which are part of the part of the fund's vision, often the impact becomes impact reporting than impact lens while investing, right? So it's always the ex post thought that comes at the end of the year or while raising a next fund to kind of look at what impact we have created. So where impact created becomes kind of icing on already a good commercially viable investment, right? So, but if you look at, so that's not impact investing in a way. Impact investing is impact first. You have a similar lens of financially sound or bankable project at one hand, and the theory of change or the impact that you are going to create with that investment, hand in hand, going to the table of the decision makers before you take a decision, and then throughout the project life cycle you track those impacts and see how your theory of change that you had in your mind when you approved a certain project or a certain investment is still tallying out, or are you doing better, are you doing worse, or whatever. So with that context, I mean, the impact investors can always go, like I said, a little less on return on invested capital, while they know that the impact they're creating is pretty significant, right? So at FMO, what we do is that, like impact in Bihar or Odisha, which is the least, or East India for that matter, which is the least development developed states of India, the impacts created are much higher in terms of differential impact. That's where FMO also look to invest more into LDCs, which are the least developed countries, FCS, which is called the fragile and conflict-ridden countries, where there is a civil war, there is a military coup, the institutions are not strong enough, other investors are not really keen on investing there, and there is huge inequality, huge opportunities. But due to these geopolitical risk or due to lack of institutional arrangements, people see those risks as very high towards their risk appetite. And I mean, no impact investor or commercial investor alone wants to go into those situations. That's where FMO finds the sweet spot in having the targeted impacts much higher while still being additional in terms of financial additionality. And the unique challenge there is always to balance out the risk in terms of reputation. So a lot of the time when you are moving into a certain area where nobody else is there, a lot of the time the communities have certain other expectation of the project, right? And when the expectation mismatch happen or whatever, it really gets blown up in media or whatever. So from a ESG standpoint, we always want to see that the community stakeholder relationship and the social license to operate of all these impact projects are well handled, so that while we chase impacts, we are not putting our credibility at risk and our kind of investment at risk. So yeah, from that context, concluding, what we look at is basically 99% of the cases, the impact and the impact thesis and the impact labeling is done ex ante before the investment is approved. Maybe only in 1% of cases it's exposed, but that is still before the first money hits the bank account of the entrepreneur. So it's always the similar lens that we apply before investing, not really that account afterwards and just say, okay, we achieved this much.
Sure. Just a very quick follow-up, Swarup, before I let Sowmya also respond on this. I'm curious because I just heard you talk about specific situations where you invest. Maybe others are not really investing there. You see that as an opportunity, while it could, of course, backfire, but it could really go well to unlock some potential that nobody else is seeing. Quick question on fact is, I know that most DFIs and financial institutions have their own exclusion list, where they are clear that we are not going to work on this industry or this geography or something to that tune. Just out of curiosity, I want to understand, do you think DFIs, not specifically talking about FMO only, but if you can, then respond for it, have such exclusion lists where specific businesses are mentioned, like we'll not work with XYZ Private Limited? Is that a possibility that you have seen where the exclusion list talks about specific business names?
The DFIs. I lost your last 10 seconds, Smita.
Yeah, sorry. I was just saying,
I don't know whether it's my connection or yours.
No, I think it's her connection because she's breaking to me.
Can you hear me now? Yeah. Sorry about this.
Okay, you rejoined.
Yeah.
No, I got your question and I respond to it.
Sure.
Are you able to hear me? Yeah.
Yes.
So what I was saying, that the exclusion list and certain exclusionary criteria are typically in the DFI MDB space borrowed from IFC, and then each DFI adds on to it based on its domestic kind of legislations, its major shareholder interest, or its ethical consideration, or things like that. For example, there is a exclusion list of IFC that we also follow. But we also have position statements on certain industries, like if, for example, animal welfare, when it comes to agriculture, there may not be exclusion in terms of we won't invest into the pig value chain or the pork value chain in a way, or we won't invest in a poultry value chain. We will do, but so if we see that there for each such topic we have certain position statements which are also available in public domain. So then we set out certain principles, right? So for example, 5 principle of animal freedom. So they should be showing their natural behavior when being raised. They should not be caged for the entire duration of their life period. They should not be showing distress. They should be culled in a manner where they feel the least amount of pain. So these kind of things, which are not black and white in an exclusion list, can also become a go-no-go tool if we see that the proposed investment is not really aligned to these 5 freedom principles, let's say, or they are not willing to align to in certain years of time. So those are then becomes as good as exclusion list, and we don't go into those sectors. Similarly, we have for fossil fuel. Similarly, we have for
just in interest of time, Swarup, I'm so sorry, but I'm aware of the exclusion list sector wise, and getting in, there could be specific conditions in those sectors. I'm curious that do we specifically call out certain businesses by their names and say these are not acceptable, we're not going to work with them? And if you've not seen
the ones that you are saying is part of typically AML and KYC check. If certainly have a history, they have a certain European UN by US. So then individuals gets a tick on AML and KYC checks, and then you don't have to do business with those.
Also, Smita, just to add on, right, there is no set of companies that are banned from investments, right? It's also depends on, your own investment thesis, the size of the fund, and the ability of the fund to manage those ENS risks when we are Aavishkaar wouldn't a category A company where the risk is so high that we as investors putting in say $5 to $10 million will not have any control on the business, right? Because the capital that's required for those kind of projects is huge, and you'll be probably 2% or 1% of the entire investment, and you don't have that much of leverage there. So we also pick up companies that where the risk is manageable. So, and like Swarup rightly said, there are a whole lot of checks that are done pre-investment as well to ensure that the business is aligned to the sustainability goals, ESG risks that are manageable. If at any point we feel they are not manageable, we will not go through with the investment. If any action plan is put in place and the company is not able to implement it, right, because it's going to add to the cost, or there's no intentionality from the founder to even do that, so those are the cases we typically say, okay, we step back and we say maybe this is not the right investment for us.
Sure. I think this is a lot of work. If I look at it even from, perspective of that when we are proposing to invest, I mean, forget about when you are actually monitoring the portfolio and looking for assessments, but even much before you are doing the investment. And I'm sure that all of this is going to then progress through the life cycle of investment, all the work that you're talking about with respect to impact, what value creation can be done across which all stakeholders, and then what are the potential ESG risks, how do we manage them? So considering there is so much of work around it, what frameworks, tools, or metrics have been most effective in helping organizations like yours to align with SDGs while also assessing ESG risks? I mean, are there any examples you've seen working very well across sectors or geographies? Sowmya, you could go ahead.
Sure. So, see, there are multiple tools that are available, right? But from an investor perspective, we typically follow the IFC performance standards because that is globally accepted and it's very in-depth, extremely understandable, simple. So we in each fund has a ENS management system that has IFC principles embedded on how to, understand the risks of the businesses we are investing in. So for when you look at from an investor perspective, we use the IFC performance standards. But from a company perspective, right, there are multiple, frameworks that are there. There is the Global Reporting Initiative, right, that looks at indicators and guidelines to assess environmental and social governance impact. Again, that is linked to SDGs. Then you have if you look at purely from a impact perspective, you have the UN Global Compact. Again, they help align business strategies with SDG principles. Then you also have the IMP, the Impact Measurement Project, essentially that helps businesses and investors also manage their impact or people, planet in a consistent manner, right? On how to approach the whole impact piece. So it has specific definitions and practices around, they call it the 5 key dimensions, where they measure outcomes, impact, all of that, and whom, where is it intentional, all of that. To me personally at Aavishkaar, what we use is the social impact measurement framework, which is sort of aligned to the theory of change. I think that's an excellent framework for even enterprises to adopt because it's very, very simple. You're literally mapping the activities that lead to the intended outcome or impact, right? And it's a step-by-step process. So that sort of, gives a logical approach to not only, what could be the path of impact, but also on how to measure it. So typically when you look at it, you have your inputs, you have your activities, you have your outputs. Outputs help you understand what KPIs you can measure. Then you have the outcomes and the long-term impact. So that sort of, gives you like a framework on for companies, especially if they want to start. And of course, there are ESG, like I said, GRI, then multiple, depending upon the sector you're in, you can choose your framework.
Sure. That makes sense, Sowmya. I think most of them we've also had experience with, and we would totally +1 on all the things you've said. How about you, Swarup? What are your frameworks and tools that you are able to leverage?
Yeah, so I'll keep both the buckets separate in terms of ESG and impact. So ESG, yeah, like Sowmya said, the basic is IFCPS and ILO. ILO's core labor requirements. And then we are signatories to UNGC and signatories to Universal Human Rights Declarations and UNPRI and things like that. So, and then every sector has its sectoral guidelines as well, either from IFC, where IFC is not there in terms of putting out a guideline, we try to put our own guideline. For example, in forestry, for example, in VC fund investments. FMO and along with BII or some of the other leading DFIs, we try to put a certain guidance in public domain for others to start using it and knowing that, what expectations are to be met when you deal in certain sectors which did not have that clarity before with, let's say, IFC in terms of sectoral guidelines. So that is one bucket of ESG risk management tools. But then you also have sectoral initiatives which are industry-led initiatives in a way, right? So which sometimes have a lot of overlap with IFC or the things that we are looking for. At the same time, it has a certain sound business sense built into it because it's kind of a industry-led effort towards stewardship, right? So when the audience in front of you is or the ecosystem is very is very aware in dealing with that industry-led standard, and you are coming with a IFC PS, and they may think that this is another burden. So what we do is then when we try and explore a certain sector, we either try to build upon that industry-led standard or kind of tag along with that standard. For example, in forestry, so there is a Forest Stewardship Council FSC certification in terms of forest product, wood products, and things like that. It ticks a lot of boxes of what we want to see, right? In terms of whether it is benefit sharing, whether it is sustainable forestry angle, in terms of traceability, in terms of a lot of these things, right? Same for aquaculture stewardship standards, so AC standard, FSC standard. So lot of the times when these standards are mature enough, and they kind of tick most of the boxes of IFC, but kind of contextualize it better for the industry or for the people who are using it. We try to kind of put them in the forefront, or tell them to follow a certain standard, and then we see that if we piggyback on those standards, anyway we are meeting our standards, right? So whether it is for large hydro projects or similar kind of things. So those are the ESG tools that you typically use. For impact, you have a lot of tools these days, from GIIN to IRIS to many of these things, as well as in India context, Niti Aayog also puts out a lot of KPIs, for example, aspirational district program. So how do you create more impact in aspirational district program versus a area which is somewhat developed? So a lot of these things are can be operated together in a coherent manner, but depends on the person using it, and not to stretch themselves too well and too broad, but try to have the thing.
That's a very interesting view on this, because you're right. A lot of times, a lot of these frameworks become a burden. And if we actually have a mature, industry specific, and much aligned to your investment thesis in that industry, and captures all those points, I think no harm actually piggybacking the same standards and saying, okay, we are going to use this one for this industry. And while it may not we may not be blessed to have it for across all industries, but even if we are able to do it for few of them, that's going to be very effective and efficient for investors. Great point. So thanks for it. And at this point, maybe what I'm more interested in hearing from both of you is a little bit more practical examples. So could you actually share one or two examples where ESG risks, risk insights, or SDG alignments transformed the way a project or investment was structured, and it led to a stronger outcome? And because I can see that we are short on time, maybe I'll just also add another question to this, that while you're sharing the example of where you have actually done some good work leveraging the ESG risk insights and SDG alignments, if you could also share your toughest challenges that you see in this space of genuinely aligning with these SDGs and managing the ESG risks.
I mean, Swarup, you can take up if you
No,
want.
go ahead. You can give more India specific examples. I'll try to add some other examples. Yeah.
Okay, sure. So see, from the risk perspective, right? Some of the investments we've made in the dairy sector, as you know, dairy uses a lot of water in terms of rather the not the dairy sector per se, but if you're like processing any sort of dairy products, it uses a lot of water in terms of washing, cleaning, all of that, right? And most of these are let out into the community. So when we were investing, I mean, this was like, say, 12 years back, there was no like proper ESG framework in place to say, okay, they need to have a ETP in place, all of that. But, we started, way back, and we realized that it's very important that businesses also run ethically. So we started assessing in our own way. Now the systems and frameworks are more robust, but we started understanding what are the risks that the potential businesses could cause, right, to the community, to the stakeholders across. So we were very insistent on the company to have that, recycling facility or the treatment plant within its business facility itself, and that led to a lot of positive outcome, right? And also, to give you an example, the other example is our Global Supply Chain Support Fund, where we are not just investing in India, but also we are investing in African companies. And these are in typically SMEs that are part of the value chain, exporting value chain, right? And they have no understanding of ESG or how to implement it. So we were thinking, instead of making it a compliance point of view, can we make it a value creation for them? So we work with the founders very closely to identify what are the value drivers when you implement ESG. So if they are having proper policies in place, right? Say even labor policies in place, does it lead to productivity uplift? Does it lead to better retention? Does it lead to, inclusivity in terms of gender? So we sort of identify, what are the risks, how well the company is prepared, and what is the value creation that it would possibly create if they were to change small practices within the organization. And I mean, I can give you multiple examples. We've invested in, textile companies, right? So by adopting, say, a Higgs framework, to measure how they're using their resources, right? And creating that standard, they are able to save on cost. Because they are efficient, they are able to attract better clients, better price premiums as well. So, I mean, these are the sort of examples, the multiple examples. So we have looked at ESG more from a value creator rather than from a purely compliance perspective that the companies need to deal with. And of course, on the impact side, we have multiple examples. Our investments in, Argos in Bihar is a classic example. So here, I mean, 60% of the farmers are like smallholders, 60 to 80%. And, they are producing half of the grains, right? Half of the grains in India. So, but if you see, most of them struggle with low incomes, there are broken supply chains, post harvest losses, all of that. So we identify Argos, a company in Bihar that looked at this challenge and said, how do we increase farmers' income, especially in a place like Bihar? So they launched a grain bank. So what's special here is that it lets farmers sort of digitize their grain stocks, right? Provides doorstep post-harvest solutions to them. And it also runs on a technology platform seamlessly. So the farmers can look at and say that, okay, this is the price I want to sell it. Rather, he has a choice saying this is the price I want to sell it rather than, giving it to a trader at a price that, is requested by the trader. So it is purpose led, and the founders are first generation entrepreneurs deeply connected with local realities. So we have seen through our investment that the farmers' income has consistently increased by 25 to 30%. And this is the sort of impact that, businesses can create if impact is embedded within the business model.
Great, great. I think that makes a lot of sense. And that's probably the thesis with which we all are driving the SDG impacts assessments or even looking at the risks. But have you faced any challenges when you're trying to do this? I mean, I know there are multiple, there are many. It'll be we only have a few minutes. So if there's anything specific that you keep seeing coming up again and again and again, and we are still facing the same challenges.
I think that the lack of understanding, right, of how this can help the businesses scale. So everybody talks about sustainability, everybody talks about ESG being relevant and everything, but there's no clear pathway. I think nobody has cracked on saying, okay, this much, if you change this, it will lead to X amount of top line improvement or cost productivity, lowering cost, productivity increase, all of that. So I think somewhere, because there's no quantifiable measurement, people, ESG, the moment they look at ESG, they think it's cost. Businesses think it's cost. I don't want to touch it, right? Why should I do it? So the challenge is always, changing the mindset. There's always like, okay, while there shouldn't be a trade-off, there is a trade-off of some sort. So you say, okay, make these small changes as the business scale. Let's see if we can institutionalize them, and therefore it becomes better for the company to run in a sustainable manner, right? So, I mean, challenges are plenty, but I think the basic thing is lack of understanding. And it's not just with the businesses, right? It's a sector problem. It's not a single business entity problem.
Absolutely. I'm, so agreement with you on this challenge. It gets very difficult to even explain people on what these things are. But maybe that's an opportunity for us. Maybe all three of us could sit together someday and make this work for them. Because most of it is so contextual. But still people want to see that silver bullet that, yes, I'll do this and that will happen. So we'll see how we can solve this one in future. But for now, Swarup, if you would like to respond to how have you been able to, if you can share one or two examples, and at the same time, what challenges have you faced? when
So Sowmya got me at top line, bottom line, and I think I lost my track of the argument there. So yeah, just continuing from there, I think in my previous job, that was kind of my JD to really showcase how much value does ESG create, right? And when we talk about value creation, it's most of the time the first step is value preservation. How much losses are you preventing? How much you could have lost to production capacity, production time, management time due to one accident, than how much you saved by preventing one accident that you had, let's say, a certain frequency of accidents last year versus this year, when you invested in safety systems, you invested in training, awareness building, this and that. How did it contribute to your top line? So these are the questions typically you have to answer as a business as you grow. ESG has been mostly driven by some sense of demand from consumers, from markets. But when it comes to companies, they have to look at the balance sheet, right? The cost has to kind of make sense for the board as well to approve huge amount of team cost for disclosures, for this and that. We can talk about competitive advantage, this and that, but everybody wants to see numbers. And I think this is somewhere you will see a lot of progress in the next 2-3 years, because a lot of universities are also working on creating these methodologies. So this is an industry view that I shared with you. On FMO side, I think most of the impacts that I echo with Sowmya, we try to have a lot of those kind of targeted towards smallholders, because of just taking the agri example. So how to protect the smallholder interest, how to formalize the entire ecosystem, how to make sure that they are not over indebted. Most of the time you go ahead and start with a company that is purely a trader of certain communities, certain commodities like a coffee or vanilla or any of these products, a cashew, in a very underdeveloped part of the world, in Africa or Latin America. Then your companies kind of start facing the heat of climate in one point, because it destroys your supply chains. The commodity pricing fluctuates so much that you are not able to have profits, you are not able to protect your supply pool, right? That's where the challenges come from, that your farmer must have taken a loan from somebody else to create a certain cashew or kid. Now this year the cashew crop is damaged, he is not able to do this. So this for financial people, it is the counterparty risk. For us, it is the supply chain sustainability kind of thing. So how to basically make sure that the resilience across the supply chain remains is the main risk that we, or main challenge that we are kind of working on for the agri side of the businesses, and for the forestry side of the businesses as well. But for the market, what it wants to know is when you bring a certain commodity to market and say that it is ethically sourced, sustainability integrated, grown, and things like that, they all want to see traceability, right? So you want to put a certain rice as a ethically or responsibly grown rice versus a normal rice. You want a certain premium for that product, but then you will have to show the traceability, that it did not lead to ecosystem damages, it did not lead to deforestation across the value chain. It ensured that a certain amount of minimum payment or whatever, transparency is integrated, payments are done in time, people in the supply chain are well protected. Then it becomes a truly ethical product or a truly ethical commodity, right? So traceability side and the climate induced impact side remains the outside in risks for these impact propositions that we are still trying to solve for.
Absolutely. I think one of the things I would really agree with you on is this ability to trust. Like when people are bringing in all these jargons and simply labeling their products or services with these how much do we trust them? Because traceability has yet not caught up, to be very honest. Even if there are systems where things are happening in the ethical way, having a proper traceability across those products or services is still not easily accessible. You can't still go and validate and verify. So I think I do agree this is a big challenge for the sector. And hopefully, again, one of your startups, one of your investment portfolio companies solves this too. But coming to the conclusion of this conversation, I wanted to ask you, we've already discussed a lot on what work we've done so far and what we are seeing currently, and how we are integrating ESG risks and SDG impacts together, and what are the challenges you're seeing today, and what trade-offs you're making to ensure you're still on your path of value creation, as well as risk management. But looking ahead, what do you see as the most critical ESG risks and SDG priorities that businesses will really need to prepare for in the next 5 to 10 years? Either of you could go first.
I would say climate. Climate is a key thing because we could, build homes, we could help farmers, produce better, but with one cyclone flood, everything is like just gone, right? Houses are destroyed, productivity or the crop grain or the land is like destroyed. So climate, I think, would be like the top priority and should be the top priority.
Absolutely. I think World Economic Forum definitely agrees with you. Their risk report talks the same. So yeah. Swarup, you want to add to this?
Yeah, I mean, I stressed upon climate as well, but when it also comes to climate, a lot of the times you hear question about, the quantification of the damages in the supply chain and how much of your, a company's financial situation was really affected by a certain climate event, right? So those attributions, those models are still evolving at the, for decision makers, while at the same time, practice is also evolving in creating more resilience in the market. Most of the climate investments in the past 5-10 years have been towards mitigation, but nowadays the clear focus is on adaptation and resilience. And as the adaptation financing grows and success stories come up and replicated across geographies, I think we'll have some sort of sense of accomplishment in that area soon. But I think time is of essence, like anybody knows. But overall, for innovation-led businesses, I think the theme for me, I mean, as a professional in my previous life also, I operated with line, which is, response conscious scaling down. So a lot of the time, innovations in a sphere where you are the first mover, you have an advantage, but you have also the disadvantage. So while you create your business, integrate responsibility or elements of that without asking why now. I have a proof. I have a series A or cross that barrier, and then maybe so there are 99 other things. So rather than asking the why, if innovators know the how part, commensurate to their business size, there can always, even if it is the intent part, which is the first part in ideation phase, you have a product, but at the same time, what is your intent on impact and sustainability? So integrating those two philosophies together as you scale up responsibly. If you are going to wind down, then do some conscious winding down and have some kind of homework before on how do you want to wind up a certain business. If that becomes a reality, how will you fire people? What will you do about it? How will you pay your vendors or whatever, right? So that is the main challenge that I see in ventures, innovation-led ventures, is to keep a tab on both sides. I mean, explore all the possibilities, while also having the right intent, heart in the right place, and also planning for the failure.
Absolutely. Any closing thoughts from both of you, where if you had to just give one piece of advice to business leaders and investors? I know, Swarup, you kind of made a point there, but if you would like to add to it. And Sowmya, if you could also share, if you had to just give that one piece of advice to business leaders and investors who want to scale purpose-led innovation responsibly, what would that be?
Swarup, please.
So I think most of our audience is from India, and as a civilizational state, we have always innovated, asked questions, and I think we should be kind of continuing on that path. But we should also know that the financing is short in India, and the financing moves from west to east, right? So if waste is coming out of with certain jargons or certain frameworks, don't be scared about it. We should know how to deal with it, and unless we know that, we cannot have the financing flows to India, and unless the finances flow in a large amount to India, which is kind of a beachhead for the global south, we are not able to innovate solutions that we want the other global south countries to kind of adopt to. Whether it is, I mean, you can take a lot of success stories out of India, from the digital stack to the DPIs, to many of the innovation which came out of India is now helping a lot of countries which are LDCs. So for a very widespread impact across the globe in a very short time, India is kind of the incubation center. So people should be very proud of that, but also they should be very conscious that the capital comes from west. So we cannot always ask why, but just take a step back, relax, and say how,
Sure,
and
sure.
we will
Thanks.
succeed.
Thanks, Swarup. Sowmya, you want to add to that?
Yeah, so if I were to give one piece of advice to business leaders and innovators, right, on who are looking to scale this whole purpose-led innovation, like you said, they should focus on balancing profitability with social and environment responsibility. It is very key. You need to think of, creating impact or that's going beyond capital. So it should embed sustainability deeply into business models. It's about centering around the communities you're serving. It's about fostering long-term relationships that align capital also with real challenges, all of that. So this means that business leaders and innovators or investors need to listen carefully to the context, right? They operate in, and make impact really the core. It has to be measurable, part of their strategy, and not just like a side note. And I think that's the only way to truly achieve a world without hunger, without poverty, and inequality, as outlined in the vision of the UN SDGs.
Absolutely, absolutely, Sowmya. I think great insights from both of you, Swarup and Sowmya. I can't thank you enough for really bringing all your experience and your tremendous insights into this discussion. I know that we have questions, about 8 of them already, and I also see Prasanna here on the attendee list who's also asked questions. But in the interest of time, what we are going to do is we're going to share all these questions with you. And once you respond to those, we'll share it back to the attendees. I hope it works with both of you, Swarup and Sowmya. And
Yeah,
yeah, and attendees, please don't be disheartened if you have sent a question. We are going to respond to you. It's just that we have overshot by a lot of time, and I'm sure Swarup has meetings, Sowmya has meetings, and you all have more things to go to. So we're going to close this and conclude this webinar for today, with a promise to respond to each and every questions that have come our way for episode 4. And looking forward to meeting you all in episode 5 then. Thanks,
Thank
Sowmya.
you.
Thanks,
thank you
Swarup.
very much.
Thanks
Thank you,
everyone for
Guru.
attending.
Thank you, Smita. Bye.
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 Thanks.